And the end of that music and all of those legal words means we're ready for another episode of the halftime report. S&P stalling at resistance a little bit ahead of the CPI report tomorrow on a light news day when we've got lots of macro stuff, and we'll cover that and give your take on all that. But before we get into the charts and the analysis, and then another edition of Fundamental Focus by Coach Greg Holmes, pleasantries as always. Matthew Justice. How are you doing this morning?
Matthew, you and Mom, that's about it. That's the list right there. You found the list. There's two. You, Mom, that's about it. Mark, I'm doing absolutely fantastic. Excited to be here to break down a nice little market resistance, holding a little bit, but I don't think that's necessarily a bad thing. We talked about this a couple days ago. Give the market a little bit of time to play defense at the higher elevated price. Gives a little bit of confidence to the market, in my opinion. We'll break that down technically here in a moment.
Yeah, no, I mean, and we have, that has been like after the rally we had at the start of the week. I mean, I heard Tyler, I echo those sentiments. I'm like, you stall here and hold. Mm-hmm. That's a good thing. And we'll break that down from a charting perspective in a second. But, I would be remiss if I didn't welcome our brother from Canada, Mr. Down Arrow on his chart. Listen, the world will have ended when that chart in the background actually points up. The world will have ended.
You know what the worst part of that is? It's actually supposed to be an up arrow, but when I brought it forward as a back screen, it mirrored it, it flipped it, and I don't know how to flip it back. So you know what? From now on, it's a down arrow, but that's all good. I'm happy to see the markets up anyway. So I
have a couple comments that I will save till after we get done with the halftime report.
There you go.
Yeah.
Listen,
there's a button, Greg. It says mirror.
I know there is a button, Matt, but if you know me, and I know you do,
I get it.
Technologically challenged, dude. I can press the mouse button. That's about it. So
listen, I'm screaming at my computer every now and then. Why won't it work? Just hit it with a hammer. We're good.
That's right.
So, yep, I get it.
Matt, let's start with the charts. Let's break down the S&P. We talked about a couple days ago that if this exact scenario played out, it wouldn't necessarily be a bad thing. Will you break down what that means from a technical perspective?
Well, number one, you're in a market recovery scenario where you have a heightened sense of volatility and a heightened sense of price action, and the market does seem like it wants to overreact to news that it typically does just kind of take that happens in the market. They take it, we move on. But so we're in this heightened sensitive environment from a technical perspective. You got a big downward movement in price followed by a big upward movement in price. I haven't really seen, and I said this a couple days ago, but I haven't really seen any volatility shifts. Even with the upward movements in price, the volatility skew is about the same. And so I do think, and I said this on Monday, I said it on Tuesday as well, I do think it's important as this market does recover that it shows that it can play a little defense and that the volatility starts to slow down. And that's an indication that the market isn't overreacting to every single piece of news that's happening on a given day. And so, for example, you take today, for example, there's just not a lot of news in the market today. There's not. It doesn't mean CNBC is not trying to do their best to make some news, but there's just not a lot of news in the market today. And yet today you saw, Omicron is the reason the market's going down. I'm like, it's a doji. What are we doing? Like we're trying to force price action, but price action isn't following the news cycle. And I think that's a positive thing, that you still have the media out there trying to paint this scenario like it's extremely concerning, when it's, okay, we've been here, we've done that. Let's give the scientific community a little bit of time. Let's see if the vaccines can offer some immunity to this new variant. Let's see how, AstraZeneca's medicine, how that over-the-counter medicine, how that attacks Omicron. Let's get some answers before we overreact. That's all I'm suggesting, and I think that's all the market is suggesting is, guys, we've been here, we've done that. We overreacted to a certain, and I'm talking as market participants, not a tackle, Mark. I said this yesterday. You've been pinpoint on your analysis on Omicron and the market's reaction, but as broad market participants, we overreacted a little bit over the course of the last week and a half with the volatility. So I do think that having the market slow down a little bit, play a little defense, and solidify this breakout channel here. And so when you're looking at this from an intraday perspective, you see the market recovery here. It comes right back into the same levels that we were fighting up against a couple weeks back. And I do think the market playing a little defense, meaning you don't see the market push right back down to 4,500. You see the market play a little bit of defense up at the top range. You clean up that resistance breakout channel right there about, I believe Tyler gave it the 4720 handle. I'll go with that as well. I mean, it's not exactly a pinpoint number here, but I do think that 4720 kind of represents the zone. And so you're looking at this playing a little bit of defense here, slowing down the news cycle a little bit. The market's not overreacting. And we're now going through the second day of this. And I do think the longer this transpires, where the market is not overreacting to the given news cycle and the market isn't puking up some of these short-term gains that the market has recovered, I think that's a positive development for the market moving forward.
Absolutely. Greg.
And again, we still got to see a little bit of it, right? I mean, obviously everything is conjunction with a breakout here, but I do like the defensive nature of the market.
Greg, what's your just general take on the market right now? How are you approaching it?
Yeah, so it's a kind of a wait and see right now as far as I'm concerned. We got this recovery that's decent, but Matt kind of broke it down pretty well there. We're just stalled right now, and I'm okay with that because it allows the moving averages to catch up technically. Mm-hmm. It allows a lot of things to work itself out, much like the news that Matt talked about. Give the scientists some time, let's figure this thing out, and then go from there. I think it's a positive thing as well, just because it's always better as far as I'm concerned. One of my mentors taught me many years ago, nothing ever goes straight up and nothing ever goes straight down. So, we got kind of a U-shaped recovery here from the last couple of weeks. Now it's taking a little bit of time off. Well, guess what? We'll get the next leg when it comes, and it could be higher if it breaks that level that Matt talked about. Maybe it pulls back a little bit, makes us a little cup and handle action here. It's all good that way. So for me, I'm keeping everything very, just very steady. Nothing, trying, as Matt said, not to overreact to too much of the market movement is really what I'm trading.
Can I take a moment just to kind of paint a little bit of a picture here that might add a little bit of perspective? When you're seeing this type of market, oh man, not that one, not that size there. Let's go ahead. Let's get something a little smaller there. When you see that type of number here, and you're talking about a market recovery, having the market maintain support levels from an intraday perspective is important. But like Greg talks about, having the market give it a little bit of time for these moving averages right there to catch up, and it doesn't take a long time, but just a little bit of time for them to catch up. You're looking at the market right here at the breakout point, and you're saying, I like the market recovery, but I'm going to really like a breakout here. So one thing, and we say this all the time, it's not exactly the same scenario, but it's one thing for the market to hold support. It's another thing for the market to break a resistance point. That's what we're talking about. The entire price action over the course of the last 2 weeks is all about this breakout channel. It's not, the trader isn't like, oh, just recover what we lost. No, we're looking at that next setup. We're looking at that next trade. We're looking at that next opportunity. And so that next opportunity, when you're a top-down analyst, is, okay, where's the market resistance channel? Is the market going to break out? Can I expect another leg up, similar to the leg up we had following this recovery after a market reversal? And so you're looking at that breakout and you're saying, okay, what do I need to see in the price action that gives me the confidence that I need and the confidence that I need in this breakout? And that's what I'm talking about. And when you're looking at this, a little bit of a flag-based pattern that comes down and reestablishes a new support level that is higher than that threshold, that would be a positive development. That's something you could see. That would be in the flag-based pattern that would come down, maybe test those moving averages a little bit. And then the second one you're talking about is what we've been talking about all week, is that as the market tests resistance, consolidate, high base, give us some confidence in that intraday analysis moving forward, because if all of this short-term analysis does play out the way the way we're painting here, the way we want, what you're really looking at here, and again, smoothing out that volatility a little bit, but what you're really looking at here is a breakout against those longer term charts as well. And so you're just trying, the market is in that moment in time, and it happens a lot. We talk about it literally here all the time in the halftime report. It's trying to align time frames here. And when you're coming out of volatility, regardless of whatever the news is that creates the volatility, aligning time frames takes time. It just does. And I give the analogy of the day trader versus the swing trader versus the position trader a lot, but it's true. The swing trader's confidence doesn't start truly building until those day traders have some consistency. Those position traders' confidence levels don't start increasing dramatically until the swing traders start seeing a little bit more consistency. And what I'm talking about in that is that multiple time frame analysis, to where you truly do see the powerful legs where it becomes. And what I mean by that is those legs up, those traditional higher highs in the higher low, higher high trending environment. It's when you see those easy markets is always when those time frames align. And so that's why we say when the volatility hits the market, it's not necessarily about the news, it's about the volatility, it's about the time necessary to give this market enough time for those time frames to align, and then it becomes a little bit easier. And so I just wanted to spend a moment here talking about that to clarify some of the comments that have been happening technically regarding the market over the course of the last couple of days.
Yeah, I know. And when we get that alignment, on pullbacks this year, I've heard you use that in that phrase, and then and when it is aligned, it has produced some good couple week trading results several times this year when you've pointed that out. So
listen, it's simple, Chucky. It's the heavens, the earth, and the moon all aligning one another, and that's the 30, 60-minute chart, the day chart, the weekly chart. And we're in a pocket of time where that could happen. But you got to see the consistency of the intraday analysis, and we're only a day and a half into it.
Yeah, so definitely stay tuned, because when you hear that Matt say alignment trigger, add some risk. I know I'm planning on to. Let's go over to the NASDAQ. Let's see if we're seeing anything different there in the NASDAQ chart. Down a little bit extra today, but do you see anything different in chart patterns?
No, not a tremendous amount. I mean, you both tested the 50, the S&P and the NASDAQ did. They got a little bit more chop on the NASDAQ with that failed breakout at 16,500. And so we Tyler and I debated whether or not that wick was important. And I do think you have to take it into account, but I don't think it's a vital technical area where you got to be concerned about. If the market breaks out, I doubt that wick's going to play a role in stopping the market. And so it's a little bit different at the top end, but the bottom end looks fairly similar. And when you're talking about the S&P and you're talking about the breakout of 4720, I think you're talking about 16,500 here, but you're really talking about a very similar chart with a very similar breakout channel and a very similar volatility skew over the last, say, 4 days in the market.
All right. Small caps getting beat up a little bit today. Small caps have been my goodness. When did small caps become the
they got to kick all the small caps out of that analysis.
But I mean, we are seeing a different chart pattern here. What is what are your best worst case scenarios here on small caps?
Best case scenario is the S&P 500 breaks out, NASDAQ breaks out, and carries the small cap index. That's the best case right now. You're talking about a market that got beat up a little bit more versus the blue chips. You certainly don't have as much confidence in the small cap indexes as you do those major market indexes. And the simple reality is we've been waiting on that breakout for a long time. And I haven't forgiven the retracement for not confirming. And I'm not the only trader that remembers that. And so I think the small cap index got some work to do here. And quite frankly, the simple reality is this is a bearish retracement. And I said this about crude oil yesterday as everybody and their dogs screaming for oil to go back up to $110 here. It's got to fight through technical analysis. It just simply does. And right now you're looking at a bearish retracement in crude. You're looking at a bearish retracement in the small cap index, and obviously small caps, the small and mid caps, they run very economically sensitive, very similar to what crude oil does here. And so if you're looking for an opportunity in the small caps, I don't think it's about finding these resistance channels and just begging for a V-shaped recovery to occur here. I think that's a pipe dream, quite frankly. I think you wait for a higher level of support, and then you start looking at a little bit of a more aggressive bullish projection. But up until we see that, I still think you're looking at a lower low, lower high scenario. And so traditional markets, lower low, lower high. The next projection would absolutely be another lower low. And then when you look at where that opportunity could come into, well, give me one of those numbers if you really do want a V-shape. If you want a V-shape, and I've talked about this in literally my first mass whiteboard I did for the step system about a month and a half ago, when you're looking at that V-shape, you don't chase the price. You wait for that retracement. You wait for that profit-taking retracement with less volume. We're not there yet. And the last thing I'll say about this recovery is has been good. It's been good, but it has not been with increasing volume here. The volume on the downside was absolutely bigger than the volume on the top side. And that is not necessarily, I want to remove the word necessary. I want to retire the word necessarily from my sentence a little quicker than J. Powell retired the word transitory. Retired necessary. It is absolutely lower volume. And that is always a little bit concerning when you're talking about V-shaped recoveries here, when it's not broadly supported by the market and when the market is still separating itself with the blue chips versus we'll just call it the underbelly, but you can take a look at ARK.
Let's go to the underbelly for a second, because we're seeing a similar pattern. We're seeing a similar pattern, and it is the area of the market that's under the most pressure today. So you would love maybe come down a little bit and form that higher low.
I think that's what you're waiting for. Yeah, I think that's what you're waiting for. And so
our low was at about 89, and who knows where it would form, 91, 95, 96, 97. I mean, wherever. I mean, it can do all kinds of things, right? But form that higher low, stabilize, work up, and that would be an encouraging thing.
Well, honestly, I think that's what you're looking for. And again, it's this quick recovery in the bearish retracement. I do think it's a positive development, no doubt about that. Okay, I'm not trying to say down, 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 down. What I'm trying to suggest is don't chase the price here. Wait for a better technical setup, because you're most likely going to get one. And if that does occur, what I typically do see in these types of V-shaped recoveries, and I don't think we're at a V-shaped recovery yet. A V-shaped recovery to me doesn't exist until you have a higher level of support or until you get bear stop out day. And so when you're looking at this number here, and let me get my drawing tool mark just to kind of visualize what I'm talking about, I don't think you chase the price like that. I think you allow the price to kind of firmly establish resistance, and then you chase that next price up where you get that increase in support here. That increase in support is very, very, very telling when it comes to these types of V-shaped recoveries. Too often, people think the V just goes up. It doesn't. No market just goes straight down, straight up. There's price action in between those movements. And so what I'm looking at here, if this is really going to recover, because again, blue chips, we're looking at a breakout here in the S&P. We're looking at a breakout in the NASDAQ.
Blue chips look very healthy right now.
They look like they're priced to do something, and they look like they're priced to break out. So we'll have to see it, right? But the evidence is fairly compelling technically. When you're looking at the small caps, when you're looking at the Russell 2000, when you're looking at the mid caps, when you're looking at the ARK index, the proverbial underbelly, you still got some big time increasing volatility here, and you need to let it settle down a little bit. And what that looks like is exactly what I'm talking about here, is that as it fades back down, it doesn't fade down with the type of veracity that it went down the previous movement. You see a little subtle fading action, and then you see that 95 or that 100 or that just whatever it is above 90, you see that increasing support here. And that's actually the first telltale sign in the V-shaped recovery, because as of right now, it's just a bearish retracement. And we as market participants cannot allow cannot allow traders, investors, consumers, media, whoever it is, to label bearish retracements V-shaped recoveries. They're not. They're bearish retracements.
They are bearish retracements until proven otherwise. Let's go to crude oil. I want to bring in Greg here on crude oil. You've been a well-known value investor. You trade crude oil all the time, Greg. It is something I definitely resonate. And when I heard you made your first Bitcoin purchase ever, I was like, Greg and I are becoming one again. Greg and I are becoming one again. But you trade crude oil all the time. How are you managing your crude oil positions? I mean, Matt, the technical analysis here, pretty much what we're talking about on small caps, ARC.
Not a lot of difference.
Not a lot of difference. How are you managing your crude oil positions right now?
Yeah, so I played crude oil, the big companies, right? Your Exxon Mobils of the world, things like that. And really, with this recent pullback, it turned from a directional play to a cash flow play. Now that it's kind of spun around, it's got a little bit of support behind it there. Really nice bounce off this technical level here. So again, just kind of being patient here. I do have a lot of my oil stuff covered still. But if it starts to break out from kind of this area here, I think Matt's got that the red is the 20 moving average there. If it gets above that, I'm uncovering positions at that point because I think we get another leg up in crude oil here. So,
and I have a question for both of you. We pull up Chevron's chart, just an example. You could pull up Devon Energy's chart. You could pull up a lot of charts. We saw a big pullback, and my question for you is: what do you give any significance? We saw a big pullback in crude oil. We haven't really seen a big pullback in energy companies themselves, right? A little bit, but nothing of the percentage or magnitude that we've seen in crude oil itself. I mean, what's your take on this?
Crude oil is a leader, energy is a lagger. And what I mean by that is the price of crude oil will move quite frequently a lot faster than the actual energy components, because the energy components you have to take into account fundamental analysis, cash flow, all of that jazz. When it comes to the extremely economic sensitive crude oil will always go faster than the actual energy space. And then if you think about our entire analysis on energy for months and months and months and months, Mark, was that energy over time is going to catch up to the rapid price appreciation of crude oil. Well, that argument to the downside works the exact same way, that the average price of oil going down over time will pull down the revenue streams of the energy components down over time. And so oil itself which is more economically sensitive than energy stocks are, it will be the leader. As it leads, energy stocks over time catch up to it. And so I kind of feel like the fundamentals behind the energy movement were pretty rock solid for about a year. The cash flow, they're profitable, they're doing very good. The average price of oil has done very good. There's not a lot of worry there. And I also don't think there's a lot of worry long term about the value of oil. I don't think Saudi Arabia is worried about $30 oil right now. I don't think, Biden would love oil at $30 right now, but he's not going to get it because Saudi Arabia and Russia aren't going to play ball necessary for that to occur again. And so I don't think there's a lot of worry that the net value of oil over time is going to contract that dramatically, which means the earnings coming out of the energy components won't contract that dramatically either, which means their dividend, which is king, queen, and country to the energy space, won't be threatened to be cut. That's my answer.
Yeah, I would say that the volatility because of, you think of the Exxon Mobils, the Chevrons of the world. They're not only oil companies, but they're also blue chips, right? They're blue chip names. So I think you've got a lot of volatility in the oil chart because it's got all those outstanding forces, kind of that Matt was alluding to, right? You've got this battle between the OPEC nations and Biden and all that kind of stuff. So you've got more. I want to say, I don't really like the term news driven, but there's just more forces acting on the actual price of oil itself. And I think that's where a little bit of the volatility comes. These other companies like Exxon and Chevron, the things that really affect them is a loss of ability to make sales, right? Well, obviously we got that with the Delta variant, or not Delta variant, but COVID a year or so ago, 2 years ago, whatever. That kind of took the wind out of the sails of those companies, and they suffered for it.
Mm-hmm.
Right now, with the talk that we have of the Omicron and all that kind of stuff, it's really not affecting anything necessarily for them to produce product, right? Like there's still planes flying, all these kinds of things. So I think that has a little lessening effect on the damage to these big companies, and so just that blue chip nature, there's just less volatility to it, and I think that's why you see a little bit less pullback, and that's what I've seen in the holdings that I have anyway. So
I mean, it's been a funny dynamic where you've had like Devon and Chevron at breakout levels with crude oil in a bearish retracement. It's you don't see it all the time. Maybe there's some appetite. We get constructive price movement in the coming month in crude oil.
And again, the chart on crude oil is a bearish retracement, but there is context to that. Remember that one day where it drove down over 10% and it just got crazy volatile. Well, the recovery has brought it up into those resistance levels, creating that bearish retracement. Without that massive downward movement in price, you're probably talking about bear stop out day already. And so I'm looking for crude to reestablish a support parameter. I'm not that worried about the energy components, quite frankly.
Yeah, good deal. Now,
can I just one question to you, Chucky? Regardless whether this is a bearish retracement or not, don't we all kind of see this level here to double bottom analysis as being a fairly decent opportunity?
I think it is the bottom.
Well, then why would anybody fret about energy components if the average price of oil is going to be in the upper 60s?
Yeah, no, I mean,
right?
It's tactically, tactically, I have that as a double bottom. I think OPEC put a floor in.
Well, and honestly, if the analysis works out like I discussed here today and the market starts solidifying itself, it won't even test that level.
Now, one level that is being tested and one that is on a little bit on the edge is old Bitcoin. We're trading in a short-term consolidation range, pushing towards those future potential lows from Sunday night after the volatility the past weekend. Messy pattern.
Mm-hmm.
Best worst case scenario here, Matt.
Best case scenario is the intraday analysis really firms up around 48,000. You start to see some intraday analysis, double bottom, triple bottom, quadruple bottom. You really start to see the defensive nature of the market come in around that 48,000 level. That coincides right where that 200-day moving average is in that zone. You really solidify that zone right there around 48,000. The 200-day moving average is right in the 49,000 zone. The range here on the intraday is right between 48 and 52,000. And so you really kind of, you work some time here. There's no doubt about that. You work some time here. You allow that time to solidify these patterns. And then ultimately it breaks out of 52,000. And you look at that on the weekly chart as confirmation on the weekly chart as well. That's best case scenario. That best case scenario takes minimum a few days, most likely a couple weeks, but again, that's best case scenario. Worst case scenario is 40,000 is staring down the barrel of the gun right now, and you're talking about a potential breakdown here against multiple time frames, right there around the 50-day moving average on the weekly chart. You also have that $48,000 level intraday that we just talked about. You see a violation there, and that violation goes all the way down to $40,000. That's that next stopping stone, right around that 40K mark. And quite frankly, outside of some of the moving averages, I'd say 40,000 technically has quite a bit of evidence there. Old support over here, old resistance, old resistance, old resistance. But if you'll remember this chop, and I feel that chop's fairly important here, that 40,000 is kind of it's I don't want to say it's a cement foundation, but it does have some foundation from a support perspective at 40,000. And so a violation of 48, worst case scenario in the short term, and you're talking short term, right?
Mhm.
Worst case is 40,000 in the short term. Best case is some consolidation with a breakout against 52,000. Either one. This is a coin flip scenario to me right now. I don't think any bull or bear has an edge yet.
Yeah, no, this reminds me a lot of that period in early September where you were breaking down underneath the 200-day moving average, where you hit that support and people are like, if it breaks, it could go to 30, and it never did, and eventually gave you. I mean, who knows how it plays out this time? But it's one of the reasons the rallies are so strong when that occurs is because there's real fear, there's real worry in the short term.
There's real fear, and then the bears get absolutely destroyed with bear stop out days.
With the bear stop out.
Yeah.
So this is, this is a developing pattern. You messing around with crypto at all right now, Greg?
So I've got the crypto proxies. I got a couple that I've got plays on, and I'm just cash flowing them right now. I find when this stuff pulls back, it's not stuff I'm going to get rid of. It's stuff I'm going to hold for a while. So I'm just cash flowing right now with this precipitated drop that we got about 4 or 5 days ago. I got into some in the money calls, and I'm pretty happy with those right now. So
Greg and I have literally doppelganger. Like a doppelganger. Greg, after the show, let me talk to you about some FUBU and some SoFi and some Lucid Motors. We'll have a little chat.
There you go. I think you can hold on to that. I'm going to keep my old money.
We'll see.
I love that. I love when a trader goes, yeah, we're just cash flowing. Yeah, we're writing aggressive in the money call options to offset loss on equity. We're just cash flowing.
Cash flow to me.
Tricks of the trade.
Cash flowing volatility is typically we're offsetting loss, but
let's go to an area market.
But not when it's already up 150% from the time you got in. So
listen, one of the areas that we just, it seems like there's only been cash flow in 2021 is gold. Matt, what we got going here on gold, is there any hope for gold bulls? I mean, we're still holding this support level. It seems, I mean, what's best? I love the best worst case scenario Thursday here. We got that support hold.
That's what Mark's going to do every Thursday from now on. Just have me radicalize every price action.
I want a best worst.
I'm thinking the longest time frame of importance right now is like a 60-minute chart for me. And Mark's like, give me their best and worst case scenarios on every financial asset class right now. End of the world type stuff. Hot take Thursday.
There's your alliteration. Hot
take Thursday. Hot take Thursday. Best case scenario in the short term is consolidation against the 200-day moving average. Gold's got work to do, guys. There's no scenario where a V shape you're like, yeah, let's get some. And so I think you're honestly, if you're looking at adding exposure, I think you're adding exposure at the low prices, not on any breakout here. Most breakouts in gold in the last 6 months have been snuffed out, failed, came right back down, left the bulls just to kind of, try to understand how gold doesn't go up in an inflationary environment. Then I have to talk about how, it's kind of a risk on, risk off asset class. But no, I don't really see a best case scenario that makes the bulls actually happy here. I do think you're looking at a little bit more lower prices here. And quite frankly, you're in the middle of that range. Right now, the range, once again, goes into that upper ends of the 1850 levels and the lower bands of around the 1720 mark. And so you're right here kissing off 1775. I honestly don't see anything here from a bull or a bearish perspective. So I'm just going to go with the old adage of cash flow.
And I just want to take a quick look at the Dow there because the Dow's in positive territory. I just have it, and maybe it's a gut, maybe it's a this, maybe it's a that. I mean, blue chips just feel fine. And maybe interest rates tomorrow on the CPI sensitive sectors, algos have their whatever, but man, blue chips just feel like they're not worried here, and you're seeing the Dow basically, similar pattern, right? Similar pattern.
Yeah, I mean, the simple reality is the blue chip indexes have held up in the face of the volatility a heck of a lot better than the small and the mid cap stocks have. And so, we call it the underbelly, but I mean, the underbelly will fly both up on the upside and the downside here. And so, yeah, in the face of volatility, the blue chips have recovered their price action. We haven't seen that in the small and the mid cap indexes. And so kind of very similar to what we were talking about in the S&P 500, with it kissing up against that 4620 channel on the breakout against the all-time high, or whether you're talking about, you know, the NASDAQ looking at that 16,500 level breakout, you know, very, very close to the all-time high. The Dow Jones kissing up against a fairly important resistance zone. I'm going to give it the label of 36,000 here, but you know, it's in that zone of 36,000. You're a stone throw from the all-time high. It's recovered most of the price action, if not all of the price action, off of the drop in price on Black Friday with the Omicron, when the Omicron news came to town following Thanksgiving. And so you got to be impressed with the recovery in the major market indexes. It really is the Russell 2000 and the small cap indexes. And quite frankly, where the underbelly lives the underbelly doesn't live in the same zip code as Apple, right? They just don't.
They're different. I mean, they're all stocks. They're different worlds.
They're different worlds. Okay. And so the blue chip indexes have certainly held up in the face of the volatility, recovered their price action. Again, you can look at the Russell 2000 a little bit from an understanding of that underbelly or the or the high beta growth type stocks. There's a lot of ways to categorize it, but quite frankly, and increasingly more in the future, the ARK index is a very good ETF to really kind of understand the underbelly, that those high beta innovation type companies, the disruptive type companies. And right now, I mean, we have yet to recover a couple things. Number one, again, the S&P, the Dow Jones, NASDAQ all recovered the drop due to Omicron. Can we all agree with that?
Mhm.
I mean, that's what they've done, right? Down, up. That's what they've done. You haven't done that. Even with that major big move of 12, 13% over the last 3 days in ARK, you haven't even recovered the drop in price yet.
Yeah.
The momentum is still here. And so I said this yesterday about the ARK. Don't chase the price here. Don't chase this. This hasn't even recovered the price yet. This is still fighting for some degree of relevancy, in my opinion. And sidebar, and completely irrelevant to the conversation, but what's Cathie Wood launching more ETFs right now? You got to fix your flagship, Cathie Wood. This is your flagship, the ARK index. And right now, it looks like it's got some pain in it. And so, again, very similar to what we talked about on crude oil, very similar to what we talked about on the Russell 2000, similar to what we even talked about in the S&P. Seeing a little bit of increase in support for the first time, I think at a very minimum, I think that's what traders absolutely should wait for, is at least an increase in support. And over the course of the last month, we have yet to see one support level hold in ARK. We have yet to see one support level increase in ARK. Not one. Not one. And so I'm just saying, maybe let's not call the bearish retracement everything golden when we haven't even recovered the price here. S&P, Dow Jones, NASDAQ, blue chips, that's really what's kind of holding this market and what truly has recovered. The ARK index, small caps, mid caps, those are out of favor right now. And I think they got some work to do. And honestly, I'm the last 2 days in the S&P, doji, a little bit of stabilization of price action. Obviously, we still got a few hours left in the trading day. Things can happen here, but we want to see some consistency in that stabilization on the intraday perspective. Again, we might not get that. But
Yeah,
what
no,
I
listen,
do know, my last point on this, what I do know is we're starting to see it on the S&P. We have yet to see it on ARK.
Yeah, listen, here's my hot take Thursday. If the CPI report comes in hot tomorrow, underbelly is going to get crushed. Like,
I guess we'd have to define hot, because it's going to come in
well, it's
hot.
going to come in hot, but
Yeah.
does it come in like
is a blast off, break through the expectation type hot? That, yeah, I agree.
If it comes in, yeah, I mean, yes, we're used to 6-7% inflation just being the norm. That's the normal now. But if it comes in hot, underbelly is going to get crushed tomorrow. it's going to get. That's my
I
hot take.
really hope we as society do not allow Jay Powell to walk back his transitory comment. We cannot allow Jay Powell and the central bankers to allow them to be like, this wasn't us, guys.
And listen, you want to know why the market rallied this week? Here's another hot take. Because no Fed speakers were allowed to talk this week because they're in blackout period.
Yeah. Hey, Fed.
And so all of that, hey, yeah, we need to taper, we need to raise. No, they weren't allowed to talk this week, so there were no algorithms.
Maybe they shouldn't be allowed to talk since Jay Powell's pivoted 4 times in less than 4 years when most central bankers pivot once every 10.
My gut says he doesn't pivot here.
My gut says he doesn't pivot either because he made promises to get a second term, but we'll save that to a podcast conversation.
I will look forward to that podcast. All right, so there's our market analysis. Good stuff. Listen, it's not boring right now, but I think this leads to opportunity, and I do particularly think the value side stabilizes here, and I think tech is going to be interesting to see its reaction tomorrow. But stay tuned to the halftime report for the breakdown of the CPI and all that.
I think over the next couple of weeks, you're going to start to see some markets separate themselves. Right now, a lot is trending in one another because, even if you just go to the market today and just try to read all the news, you don't read a lot of individual stock news right now. Everything is major market driven because when volatility hits the market, it's only about macro news that drives everything. But then as that volatility subsides, you start to see markets separate themselves. The next 2 weeks are going to be very telling from a sector rotation perspective as we come into that traditional Santa Claus season.
I agree 100%. All right, let's transfer to stock market. Not a lot of stock talk today. I was like, you and I are news junkies, Matt. I didn't see a ton of. I saw some Omicron stuff. I saw some speculation on CPI. The jobless numbers. We actually hit a 52-year low on jobless claims today, which unemployment market seems to be doing okay, right? Doing okay.
I've long stopped caring about labor market numbers. I know they're important to the market. I cover them every week, every month. But as an individual, you tell me there's any accuracy in those data numbers. Come on, it's kind of laughable. But I get your point. All-time low, fantastic, golf clap.
Listen, economic reports in the last 18 months have set all kinds of records and all kinds.
Yeah, it's ridiculous. It's utterly ridiculous. By the way, economists are trying to label the people quitting their jobs the great, what they call it? The great
great resignation.
The great resignation. I literally want to go throw up.
By the way, Matt, here I'm quitting.
You quit every 2 weeks. We're good. Let's go.
Hell no! Listen, I love this community too much. I will not be
kid.
part of the great resignation. No.
You said it. You labeled this hot take Thursday. I got a few hot takes I've been storing up.
Hey, let's what we got on Stock Talk. You got any earnings?
Honestly, like I talked about, Chucky, there is not a lot of stock in the news today. Apple, a little bit of news concerning Fortnite. Apple wanted an injunction to allow them to basically continue to, stop companies from putting external third-party payment systems in the App Store. That was, a little bit. Amazon got beat up a little bit by some country, fined $1.6 billion. A lot of par for the course type news here. So not a lot of individual stock news. In fact, I was looking at, for an hour and a half this morning, Mark, I'm sitting there reading everything. Briefing, Seeking Alpha, CNBC's Market Watch. I'm scanning FinViz. I'm even going through the blogs on FinViz, which always drives me crazy. And I'm like, oh man, there is just nothing out there right now. And so I got a little bit of earnings here is what I found. I was even thinking about playing upgrade downgrade today because that's how little news there was. But then even then, it's like there's not a lot of great upgrades or downgrades today either. It's all macro driven news. But again, that is typically the case when it comes to volatility to the marketplace. I got 3 earnings reports, though. I got a little bit of Reddit darling. We're going to label that one now. GameStop comes out and tries to party a little bit like it is 1999. But unfortunately, it is not for GameStop as it navigates a pretty choppy trading session after reporting a whopping, and again, wasn't the guy that they hired last year supposed to fix all this? Lost a whopping, Greg. And Greg, I know you're going to talk about fundamental focus later on today, EPS numbers, right?
Mhm.
Greg, how important are EPS numbers? Like just in general?
You and I have talked about this pretty much every Thursday for the last 4 or 5
Mhm.
months, it seems. If you don't get the hat trick, forget it.
Okay,
You're just
and
done,
Greg,
right?
is it important for a company like GameStop to make money?
Well, that's one of the things I'm going to talk about in EPS there. As
Okay.
far as I'm concerned, as a fundamental investor, trader, position trader, all that stuff,
Okay.
if it don't make money, I don't want any part of
Okay,
it.
and even when the company's losing money, isn't it important to start seeing the company lose less and less over time? Isn't that important too?
That's exactly what I'm going to
That's
talk about in
important too.
EPS
Okay,
today.
I love this conversation, Greg, because GameStop's kind of got the wrong trend going on here. Lost 45, lost 76. Today they come out with a whopping loss of $1.39. Market was expecting a gain of 22. They just, again, it's GameStop. They miss all the time. They came in at negative 139. Revenue did come in at the expectation, 1.3 versus 1.2. That resulted in a 29% increase in revenue. But again, big time miss on EPS, massive miss on EPS. Let me say it again, a horrific miss on EPS. I don't know what people are doing here in GameStop, quite frankly.
This should be of zero surprise to anybody.
Like,
This thing was bankrupt how many years ago? Like it's laughable. It's
Tim
really
asked me a
laughable.
question, and again, this Hot Take Thursday, right, Mark?
Yep, Hot Take Thursday.
Hot Take Thursday. Tim asked me a question today as I was talking to him about GameStop's report. And he says, "All right, Matt, it's $161 right now. Where would you see fair market value?" And I said, "Quote 2."
Negative 16.
And he's like, "To what?" I'm like, "To whatever you want." Like, 2. That's it. There's just not a lot to hang your hat on fundamentally here in GameStop. There just isn't. And quite frankly, there wasn't when it was $8, and it's not when it's 161. The fundamentals have not improved. All the money that's coming into the company, I would like to know what they're doing to revolutionize this company, because right now, from a fundamental perspective, it's just not there.
No, it is. Listen, the apes, like they've held on longer than I thought they would in 2021.
Yeah, I remember them make GameStop great again. I'm just wondering how much time they're willing to give it.
But it's like at some point you wonder if there is going to be capitulation. I mean, just give me AMC real quick.
Well, Tim says, yeah, but Matt, I mean, look, I mean, it's kind of holding up. Holding up what? It went from 250 to 160 in less than a month. What's it holding? Support at 160? Wait till it breaks.
No, I mean, and that I mean, and that has been the big thing that has prevented me from getting involved in the fund. Is that you just know that the apes are affectionately referred to as the people that invest in GameStop and AMC and Diamond Hands and Never Letting Go. They self-identify as the apes, so that's something they call themselves.
This comment section, Reddit
like
type stuff, yeah.
So
that's not our category.
Oh yeah, they self-identify as the apes. Eventually they're going to capitulate. Now, they've held on longer than I thought, but eventually they're going to capitulate. It's just, you just can't look around at so many good investment opportunities and just stubbornly hold on. That's just been my take on it. That's what's, prevented me from, normally that would be a beautiful cash flow chart, buy at support levels, cash flow.
Yeah,
premiums.
if you don't understand scale. Like if it was ranged between 40 and 42, but it's ranged between 160 and 260. Like this is a very volatile company. And again, it's not that like volatility should scare any trader away. It's just a matter of understanding what you're playing in. And right now you're playing in a company that doesn't have a fundamental foundation in any capacity.
All right, what you got next for us? You said you had 3 for us today.
I do. I went with GameStop. Let's go to a little bit of former Tackle 25 company from last year, Restoration Hardware, RH.com here. Gap up into some challenging resistance areas. We'll take a look at that. I want to get you guys a technical read here in a second. Restoration Hardware, formerly known as Restoration Hardware, RH.com. came in with a whopping $7.03 per share. See, that's how you make money. You sell things. Consumers buy things. They like your company. They buy more of your things. Restoration does a pretty good job at that. They were expecting $6.68. Revenue came in very similar to the expectation, $1 billion versus $985 million. But they also reaffirmed some guidance here as well. GameStop, a lot of companies, like about 75% of companies in the market, don't actually provide guidance. RH is one of them. RH comes in with a beat and a beat, no providing guidance. The gap up is due on the beat and the beat. And like Coach Greg just talked about, you got to start earnings. You got to start earnings season in most earnings seasons, but specifically post-pandemic, you got to start with beats and beats. I mean, that's what you got to start with. Restoration does that gap up, but you're gapping up into a very challenging technical environment. You know, if this is a stock you do follow, I'd let that 650 to 600 dollar type price zone work itself out a little bit, because this is a bearish retracement. You're seeing a little bit of selling from an intraday perspective, so it looks a little bit of fake out type candle. Let that work itself out. But as of the earnings season, pretty positive response to some positive numbers, especially on the EPS beat.
Yeah, I love the response here. I mean, the one thing that we've seen on stocks that have had really good last 12 months, earnings have come out in the last month and they've gotten punished. Just like if the market doesn't like it, if they don't like the way you pronounce words on the conference call, just punishing action. We're seeing the opposite response. I think that leads to a technical signal in the coming weeks.
I think so as well. But again, you got to let the volatility kind of work itself out here. Big upward movement in price on positive news. Challenging candle. Looks like a little bit of profit-taking candle after it couldn't justify the higher price. So let that work itself out a little bit. But let me put it like this. The earnings woke me up to RH. I can see a little bit of reversal analysis here. It's a challenging environment, but most stocks are in a challenging environment right now.
I think you put that on the watch. Let's see how that develops. All right, what's the last earnings?
Quality company and a quality cash flow company as well on multiple different
it's
systems.
Expensive, and so it's sometimes
bull puts,
it's out of
bull puts, condors, stuff like that. Let's see. Oh, by the way, one of the reasons it came off the TACO 25 is it went up too much, and I know that's kind of weird, but we're talking covered calls with the TACO 25. I got a little bit of a food company for you guys. Hormel Foods. Talked about Campbell's yesterday. CPB, we talked about their potential reversal, positive data. That wick couldn't really withstand it, but market kind of like Campbell's here. Do you like this candle on Campbell? I like this candle on Campbell.
I think that's a go as early as.
Greg, do you like this candle?
I love it because I love this stock and have for many years. So I love that candle.
Just so everybody's clear, that candle. That hammer candle, I really like that as it forms up that reversal here on CPB. So just wanted to bring that one a little bit, but another food company firing off the lows here. Not so much the food companies at the highs, but coming off the lows here. Hormel Foods firing off with an earnings report, and they came in at a whopping 51 cents. Versus the expectation. Whopping is not the word for it, by the way. 51 cents versus 50-cent expectation. Revenue came in pretty decently at 3.5 versus 3.2 billion. That resulted in, this is where I wanted to use the word whopping, because Hormel Foods, think about that, Hormel Foods, whopping 42.8% revenue increase year over year. Inflation might have had something to do with that one. But when you're looking at this, firing off the lows off yesterday, CPB firing off the lows, do you guys see some price action that maybe we should be looking at the bottom prices a little bit here?
I have a lot of interest here. Now, it's just like big green candles like this.
This one's tough. This one's tough on the candle.
It's tough. It's tough, but give me a setup following that. I thought their earnings, I dived into their earnings myself. There's a lot to like. Campbell Soup.
Decent earnings season.
But listen, and once again, a lot of blue chipper companies, like especially in certain areas of the market, man, I just don't worry about it all heading into 2022. Now, there's a lot of areas that I do. I have my preferences. We all have our preferences. But like,
Oh, it's going to be a fun environment in 2022 without monetary surplus.
it's just like, oh, wait,
Stock
Fed
pickers
doesn't have your
markets.
back. Oh, well, fundamentals are going to matter.
Stock picker markets.
Like if you don't have just trillions of dollars of liquidity lifting everything, guess what? There's still going to be some companies that do great.
If you don't have the central bank of the United States pumping billions upon billions of money straight into the major market indexes every single month, it typically becomes a little bit more of a stock picker's market. And quite frankly, I started diving into the Tackle 25 edition for 2022 this week. It's a little bit of a challenging environment for that. It's a stock picker's market far more than other years.
It is. And technicals are going to play a role because guess what? In 2022, there is going to be 1 million technical setups.
Oh, of course.
Because guess what? There is every year. That's why we love trading. But there is also going to be a ton of fundamental opportunities.
I got a question for you too before we get into fundamental focus. Mm-hmm. If you had to pick, okay, two food companies last 2 days in earnings roundup. You had CPB from yesterday. A little bit of fake out wick candle coming back, hammer candle today. Clean environment on the breakout channel. Or do you chase the price against the 200-day moving average on Hormel Foods, which is blasting off here?
I'll take CPB all day long.
I'll take CPB all day long.
I make that the hat trick. I'm going to join you guys on that hit parade.
There's so much I like here for a.
Can we start with liking $40?
Yeah, like
that's good foundation.
There's so much to like here. There's so much to like here. It's classic reversal pattern, profitable company. You know who's probably not going to have a terrible time in 2022? Profitable companies with reasonable valuation.
Cheap food companies with cheap food companies in an increasing inflationary environment with proper valuation.
With proper valuation.
Did you say proper?
that pay quality dividends for years
and
years.
I think
yes.
Man,
sign me up for those.
Man, it feels like 1983 right now.
I think they're going to do just fine. Maybe they don't outperform this or that, but like, listen, I want dividend companies more than heading into 2022, more than I did heading into 2021.
Listen, if Powell's pivot is legit and it is real, and it looks like they're going to speed up tapering pretty aggressively next week. So if his pivot to a more hawkish is real, and I'm still skeptical, but again, the evidence is there over a few days now, but again, it's only been a few days and we haven't really seen any market volatility yet. So again, if it is real, it's good. I think stocks that are not profitable right now, it's going to be a volatile environment for them.
It's going to be a volatile, it's just, and eventually that leads to real bottoming opportunities.
If you can't be profitable in the number one time we've liquidated that we have increased liquidation in this market, that we've increased the liquidity of the US dollar in this market, if you're not profitable after 12 years of the central bank at low interest rates, historical low interest rates, in an environment after 2 years of the central bank pumping in $5 trillion into the marketplace, the government pumping in another $3.6 trillion into the marketplace, and you're not profitable heading into an environment where the central bank says we're taking it away? I don't know. Yeah, give me a good food-based company with proper valuation.
Yeah, indeed. All right, listen, seriously, fundamental focus. It's a feature we've been doing for a couple months now, I believe. A couple months now here on every Thursday. Greg, who is, if we had a residential fundamental expert, it is certainly Greg. He places a high prioritization, a couple of Z's there, in the fundamental aspects of the company. And I really do. I believe in 2022, there's going to be a lot of opportunities and fundamentals. I think those companies that have good valuation, dividend paying, I think you see some gravitation to there. So I think a focus on fundamentals in 2022 is something that we need to prioritize. Now, there's a lot of metrics, and every Thursday here on Fundamental Focus, Greg breaks down a specific metric, because there's a lot of them, and what it is, how to use it, how he uses it. So Greg, I will turn it over to you for the rest of the segment.
Awesome. Thanks, Coach Mark. Yeah, so this week I'm doing earnings per share. Obviously we've got Matt talking about it there. It's pretty important. Last week, we've been talking the last few weeks here. We've been talking about ratios to determine value. Okay, so value is if you just take the basic definition of value, it's what you pay for what you get, essentially, right? So ultimately, when we look at things with good valuations, which we just got done talking about, we need to understand, what are we actually getting for our investing dollars or our position trading dollars or just our hard-earned capital, right? What are we actually getting for that? Well, earnings per share, this is where that metric comes in, and it's very, very important. It's basically, you take a company's profit, you divide it by the outstanding number of shares, and bada boom, bada bing, you got an earnings per share number. Now, that's a basic earnings per share number, okay? It's very simple. It's very easy to understand, but there's some nuances to it. But the most important thing to remember is it's an important measure of profitability, right? We talked about the GameStops of the world, right? Losing money. That's not really the companies that I gravitate to as a fundamental investor. If I'm looking at something like a Campbell Soup or Hormel, one of these companies that are showing that they can make profits and quality profits, that's what I'm after as an investor. This is where that number, the EPS, the earnings per share number, comes in. That also breaks us out into a bunch of other ratios that we can look at, and we'll do that in further segments. But this week I just wanted to focus on earnings per share because I think it's important just to understand a little bit about it, right? So when we look at earnings per share, basically, like I kind of gave you the definition, it's just profit divided by outstanding shares. But the issue with that is there's actually two levels of EPS numbers. There's your basic number, which just takes outstanding shares divide the profit. But what that doesn't take into consideration, and it should, but it doesn't, is any particular company-based potential outstanding shares, things like stock options, things like warrants, things like restricted stock units, things like that. Okay, that's not included in that basic definition. So what we have is what we call a diluted EPS, and that includes all of those things. So what are those things? Well, if a director of the company has stock options, they at any time, depending on the rules of the company itself, they can at any time create more outstanding shares, right? So when you have those outstanding shares, you have more of them. Well, you have the same profit. You've got to divide those shares. You've got to divide those extra shares. So what this diluted EPS does is it takes into consideration every potential outstanding share out there and gives you a little bit more streamlined number. And so when we think about this, we always want to have the best data we can. And so for me, I like to look at the diluted shares, diluted EPS. Okay, I think it's important, right? But anyway, once we get that number, what does it really mean to us? Well, there's a few things. Let's start with, I've got FinViz up here, and I've been using Coca-Cola as an example recently. And you'll see all this stuff here. EPS next year, EPS next quarter, EPS this year, so on and so forth, right? So it tells you, it gives you all of these metrics. Well, if you hover over this, right, it tells you right there that it's diluted EPS TTM. TTM stands for trailing 12 months. So the last 12 months, this is the number that they got. So they take all those stock options, all those warrants, all that stuff, they take it into consideration, and then they give us this number. Right. So essentially, Coca-Cola is making about $2.03 per share. So that's telling us a specific profit metric. It tells us, yeah, they're making money, which is a good idea, right? We're looking for companies that do that. But that's not the only story here. And it's not actually even the real, the best story, if you will. It's a good thing to know this number, obviously, to know that they're making money. But sometimes the trend of making money is actually even more important than that. So if we go look at Coca-Cola here, right, we want to see that they're consistently making money, 65 cents per share. I think that's a 68% cents per share, 55 cents per share. So what we want to see is that number climbing, because when we start looking at different things, right, Coca-Cola is obviously a value company. I don't think anybody would deny that. But what if we're looking at growth companies, okay? Companies that aren't necessarily making money right off the bat, but maybe we believe that they will, later on down the road. One of my favorite examples of this is Tesla. Okay, so when Tesla started out, they weren't really making any money. I got to go back a little bit here to see this, but I want to show you this because I think it's important, right? How do we look at a growth company and say, okay, is it something that we can get behind, right? How can we use this earnings per share to let us know, hey, this company still has potential, right? Just because they don't make any money doesn't mean we want to exclude them. Well, you can see here, right? If we go back far enough, I went a little bit too far back, but you can see losses, right? Oh, the losses are getting smaller. And I know this is really hard to see for you guys, but the losses kept getting smaller and smaller. And oh, look at that, we had a profit, right? And then a couple more years of losses. Oh, look at that, we had a profit and a profit and a profit and bigger profits and profits. And so we can see these, just like we look at a trend on a chart, we can look at the earnings per share and see how it's trending as well. Okay, so that's very important to understand that number. And then what this EPS does is, like I said, it opens up ratios like price to earnings ratio, things like that. And that's where we really get into the value conversation. What are we getting for what are we paying? So if we go back to FinViz here real quick, like I said, you got a lot of different metrics here. EPS next year, this is what they're expecting. It even says EPS estimate for next year. Do we know that that's not going to be, that's going to be perfect? No, we don't. But that's what they're expecting. Okay, so that gives us kind of a look, and we say, okay, well, they made $2.03 in the last 12 months. They're expecting to make more, so maybe they've got some prospects of creating more profit for us, and we get to participate in that as a shareholder. Okay. So it gives you all these kind of metrics. It's easy to see, but really, I think looking at the trends of EPS, again, we could go back to that GameStop example that Matt had. They just continually, let me get to a better chart here. They continually continue to lose more and more money, 139, 76, 43, actually showed a profit there, believe it or not. But you can see that the trend is it seems to be getting worse for a company like that. So fundamentally speaking, that can be very challenging. So earnings per share, something you should get familiar with. Again, we can kind of read it similar to a chart. It's a big deal. It's a measure of profitability. And honestly, do you really want to own a company that's not profitable? I know I can say for myself, or at least it may not be profitable at this point in time, but does it have the prospect of becoming profitable? That's where this EPS can also help us out understand that as well. So that's a fundamental focus for this week. Like I said, we'll be using that EPS number going forward in our next segment.
Thank you, Greg, so much for another wonderful edition of Fundamental Focus, where every week you try to bring some fundamental concepts and try to educate our YouTube community on those fundamental concepts. And as somebody who enjoys fundamental analysis, I thoroughly enjoy Fundamental Focus. Now say that 14 times straight: fundamental, 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 and it will put the fun in fundamental analysis. I enjoyed it quite immensely. Thank you, Coach Greg. Mark, I know you like fundamental analysis as well. You put a lot of emphasis on, understanding the quality of a company and ensuring that you have confidence in the leadership and the company's fundamentals. Are you right there with me in your joy of fundamental?
And that's the key word, confidence, because your investments will go up and down, right? They'll go up and down, depending, sometimes markets are volatile, sometimes they're steady, sometimes a area of the market falls out of favor. Trading, we trade, we use technicals, we trade. Investing, man, you have to have confidence in what you invest in, or else, man, you'll get shaken out all the time. And then you'll see your stock go back up and you'll be like, oh, why did no, it comes down to confidence in management, and it comes down to confidence in the numbers. And if you watch every one of these segments Greg's do, you pick up a little tidbit here, you pick up a little tidbit there, and fundamentals can give you that confidence. Are they growing? Is it a reasonable value? What are their sales? What are their revenues? Are they heading in the right direction? And then you can, use your knowledge of technical analysis to determine where to sell calls and enter and all of that good stuff. But at the end of the day, fundamentals give you confidence, and that is what you need in your investing.
I agree. I agree. Well, ladies and gentlemen, you have been watching the Tackle Trading Halftime Report. If you enjoy the show, you enjoy Fundamental Focus and everything we bring to our community, give us a nice little like and share. And as always, guys, we are running a special through the holiday season. You can hit up the Tackle Trading store over there at tackletrading.com to see all those wonderful specials on all of our educational products, including coaching. Or if you want to talk to one of our consultants, Coach Tim or Coach Emily, you can hit that consultation page as well and sign up for a 30-minute consultation where you can sit down and discuss your educational needs moving into 2022 with Tackle Trading. For us at Tackle Trading, we are out for today, and we will see you with Coach Frank tomorrow on Friday Fun Day, Friday Frank Day. Frank's charts coming you tomorrow. And Coach Mark, one last point.
Programming note, Cash Flow Vikings, my trading lab. We are at 7 p.m. Eastern tonight. Come join the fun if you're not a cash flow trader. Skull to all Vikings out there. And then Cash Flow Club at 8:30 Eastern with Tyler Craig. You can find both on the events page.
I gotta be real with you, Chucky, here live in front of our community. I was thinking last night, I was on Discord it was yesterday. I was on Discord hanging out, and I was a little jealous that your trading lab has Skull between you. Like, what about the rest of us?
Skull, Matthew.
There you go. I gotta figure out a nickname for my MMG, my step system mastermind thread. I gotta figure something out. Greg, you're gonna help me out with that, okay?
Do my best, buddy.
I like it. All right, Tackle, we're out. We'll see you tomorrow.